Okay, I think let us start. It is already 5:07. We will not wait anymore. Computer Center, can we start?
Yes, ma'am.
Yes,
We
ma'am.
can
Yes,
start.
yes.
Okay, fine. Uh, so, good evening, everybody. This is Deena Mehta, Chairperson of NMIMS Alumni Association, welcoming you to another, interactive session with all our alumni members. The endeavor of our association is to look at the inspiring journeys of our students who have done great jobs, and also trying to upgrade and to make our association members aware of what is happening in the environment, especially in the financial field. What is the leadership that is emerging all around us, and analyzing the fundamentals of companies to identify future leaders is today's topic. And I'm sure all of us are extremely conscious about what is happening around us. Wealth creation and the entire journey of any alumni would really center around wealth creation, because it is indeed a very important aspect of every successful financial, I would say, professional, to not only have a good job, to have a good career, but also create wealth for themselves as well as for their families. And analyzing companies become very, very important in such a scenario, because even if you have advisors who are advising you, but a basic understanding of who are the future leaders and how the financials, how the fundamentals have to be analyzed, is something that we all need to go back to our college education. We need to brush up what did we learn about analyzing of fundamentals of companies, and that is very, very useful for us in the current scenario. The stock markets have been the focus of the entire country recently. Every day you hear headlines. There are discussions of the elections outcome, and then everybody feels, oh, the outcomes are not what one expected, but the stock markets are defying all logics, and the companies which are listed on our exchanges, and the overall per capita income is going up. There is lot of surplus funds which is going to be available in the pockets of our citizens, and understanding of companies and making their investments in various instruments. Fortunately for us today, the number of instruments are available are phenomenal. You can buy gold of 1 rupee. You need not buy a flat to be invested in real estate. All the real estate companies are listed on the exchange. So every asset class is really available on the platforms of the stock exchange, which makes understanding of companies very exciting and very relevant today for the purpose of wealth creation. And I would say that we have a very, very accomplished person with us, Mr. Jatin Khemani, who is going to take us through this journey of identification of our future leaders. Mr. Jatin Khemani is CIO and managing partner at Stalwart Investments Advisors LLP, a SEBI registered portfolio management service from New Delhi. He was earlier head of research, so he is fully familiar with today's topic. He has co-founded the Investing Conclave, a digital first conference platform to let distill knowledge of the practitioners flows to the masses. Because the knowledge of investing is something, though very commonly available, it is available on every social media and the entire things, but really trying to find out the diamonds which are there in this entire market. I have spent 4 decades in the stock market. I have seen so many ups and downs, I was on the index committee of the Bombay Stock Exchange, and the how the companies which we identified in BSE index initially, and today what the companies stand, entire composition, entire sectors, everything has changed because the focus of investors has changed. The focus of what the future looks like and who is going to be successful. One would have never imagined that the PSUs would really lead the rallies many times. And actually, they were the companies which were least favored because of government interference. But as things today stand today, PSUs are doing very well. Our defense stocks are doing well with the focus of the government to do manufacturing in India. So this understanding this environment, I think Jatin is the right person. He is very popular for his 4 day residential workshop on investment lab at Flame Investment Lab in Pune, and he is a CFA from US and an MBA finance and a BCom from Delhi University. So his talks have been very popular, and that is what made us identify. I am really thankful to Mr. Rajesh Bojani, who gave this suggestion to call Jatin. And I'm sure that all of us, though I have spent 4 decades in the market, but listening about the companies, their fundamental analysis is something which really excites me even today. And I feel many times that really companies and their futures are really in my blood, and it gets me excited whenever somebody talks about it. So I will hand over to Jatin. Jatin, the floor is yours. And at the end of the session, we will have a question and answer session. But before we get going, we will, our beloved Professor Mahadevan, he passed away today. In fact, in our previous session last month, he was present and he blessed us all. So we will have a 30-second 30-second dedication to him. And after that, Jatin, you will take over. Okay, Jatin, over to you.
Thank you, Deena ji, for the kind introduction. Thank you, Rajesh ji, for the invitation. I hope I am audible.
Yes, yes, you are.
Great. So I am thankful to everybody who has joined. It's a Saturday evening. I hear that some of us have even joined from abroad, so different time zones. I hope it's worth your while, and I'm able to justify the next 60 minutes where we talk about some interesting insights into the business. So, quick disclaimer before we get into this session. This is purely an academic workshop. During the session, I may use some examples of real life companies. The idea is to just illustrate a concept or a perspective. Please don't construe this as an investment advice. Uh, the reason is because we could be biased. We may have present or past ownership in the stocks discussed. So, with that out of the way, while Deena ji talked about this, so I'm going to skip this. I'll just briefly share a bit of my background. So I've been into equity markets uh, for about 14 years now. I have seen a couple of market cycles. Uh, Deena ji has been around for over 4 decades in this profession, and I'm very fortunate to spend time with people who have been in markets for much longer than I have. And I realized that, in this profession, 10, 15 years are really nothing. You just get going, you just understand what's happening around, unless and until you have seen 2, 3 cycles, it's really nothing. So I'm really a beginner myself. I'm still learning every day. While Deena ji was very kind with her words when she introduced me, but I'm fairly young in my journey. Uh, though it's been very fulfilling and rewarding, and I'm going to share a bit about it in this slide. So I started when I was 22 years old. The Nirvana moment for me was when I read the book called One Upon Wall Street by Peter Lynch. And a bulb just goes on in your mind when you come across something which excites you like that, and you realize, okay, this is my passion and this is what I would like to pursue as a career. So that moment for me was when I read this book called One Upon Wall Street. Uh, then I was fortunate to land up a job in this industry and begin my career. I worked under two awesome mentors, got great exposure, traveled across the length and breadth of the country, got to meet a lot of promoters at that young age. So by 2014, I branched out on my own. I found this company called Stalwart Advisors. This firm is registered with SEBI as portfolio manager and research analyst. We are based out of Delhi and we blog at stalwartvalue.com/blog. The journey has been full of ups and downs, like for most people in the markets. Markets are like this, and so is our journey. That's the nature of being in this profession. But all said and done, it's been very rewarding and fulfilling. Uh, uh, we have been running a model portfolio for over a decade. It's exactly like a PMS, except execution. We also got PMS license a year ago, and that vehicle is completed a year last month. The journey has been very rewarding. So this is how markets have been since 2000. I haven't gone back to 1976. The data is available since 1976, but Sensex came about only in mid 80s. Uh, the back the data otherwise is backdated. It was not actionable because Sensex did not exist in 70s. So and then we have the Harshit Mehta up and down. So I've taken that out. I think since 2000 is more reliable to look at. Uh, so what was the Sensex in year 2000? It was 5,000 points. And what is it now? It's about 81,000. So it's up some 16 times in last 24 years. If you do the math, it works out to be about 13% CAGR. Uh, Phenomenal, right? 13% is twice what you get in an FD. And uh, so far even taxation was also negligible until 2018. It was zero. Now it's 12.5% on long-term gains. So this was phenomenal wealth creation, and that too without any effort, because this is not actively picking stocks or identifying a fund manager who will do wonders. This was plain vanilla index investing. Sensex has top 30 companies in India, from each sector: IT, banking, infra, pharma, FMCG. You know, all sectors are covered in those 30 largest companies. You just buy an ETF at just 0.2% cost, and we sit on our ass and we make 16x in 24 years. Phenomenal, right? Uh, but at what cost? So we had a 25%, 45% drop after .com. We had a 60% drop in 2008 global financial crisis. Then between 2011 and 2014, we had the QE retracement, we had the European crisis, we had the oil crisis and whatnot. Then in India, we had DeMon, GST, ILFS fallout. This was, of course, COVID. Most of us still very fresh in our minds. Most of us lived through this. Very recently, there was a 16% drop in Sensex in year 2022. So this is the cost which we have to pay if we have to make 13% returns in the long run. And I'm reminded of a beautiful quote by a lady called Marilyn. She said, I'm selfish, impatient, and a little insecure. I make mistakes. I'm out of control and at times hard to handle. But if you can't handle me at my worst, then you sure as hell don't deserve me at my best. So if we want the best out of markets, it is not possible that we avoid the worst of the markets. We have to embrace the downside and live through it comfortably while knowing that in the long run, we have won the ovarian lottery. We are not in Japan. Japan, last 40 years, zero wealth creation in markets. Since 1989, top of Nikkei. So that is not the case, right? We are a developing country. We have won the ovarian lottery, like what Mr. Warren Buffett won in 1950s, being in US. Uh, and we have 140 crore mouths to feed. We have a lot of aspiration. The internet has just taken the ambition and aspiration to next level. As and when affordability is going up, all of that is translating into economic growth. And that economic growth is going to captured very well by the markets in the long run. barring the short-term gyration, short-term dips, which we can see on this slide. So let's get deeper into this topic of equity. There are three pillars of investing, right? The first is business, which is the horse itself. Is the horse healthy? Is the horse young? What kind of history the horse had? What kind of future the horse has? So on and so forth. Everything about the business. Then there is management, which is the jockey. Who is running the horse? How competent is he? Is he some drunk fellow, or is he trained jockey who knows how to get the best out of the horse? And finally, the valuation. Uh, what are the odds? How much do you make when you're right? How much do you lose when you're wrong? That's the odds, right? Uh, all of this is useless if you don't have the foundation right. What is the foundation? It is yourself. So there are 100 ways to skin a cat, right? In markets, you can make money by speculation, short-term investing, long-term investing, uh, from IT sector, from pharma sector, from small cap, from mid cap, from growth, from value, from turnarounds, from chor bane more. There are hundreds of philosophies and styles and sectors and companies and industries to make money from. You need to know what works for you. If you don't have, or I don't have, understanding of what my psychology is, what can I stand? Uh, can I stand drawdowns? Am I okay if my portfolio goes down 50% temporarily? Uh, what kind of allocation I'm comfortable with? Can I put 50% of my portfolio in one stock? So on and so forth. So until and unless those behavioral biases, those personal awareness of our own psychology, of how we are wired, and everybody is wired differently, right? So there is no one right way. In this session, we are going to focus a little bit on business because that's all we can cover in 60-minute session. I studied this for 6-7 years. I've been practicing this for last 15 years. I take a 4-day residential workshop in Flame, where even 50 hours of classroom teaching is very little. So obviously, given the 60-minute constraint, there is only so much we can cover. So I thought we're going to go deep into this one topic of business within this a tiny topic of how to identify uh, interesting companies which can sustain their market shares. So that's the topic for today. Uh, Before that, as I said, you need to know what perspective I'm coming from, and you have to see whether that makes sense for you or not. So in this slide, I'm going to briefly cover what does investing mean to me, to my firm at Stalwart, to our clients, as a group, what we are doing, how we are doing it, and how do we approach this profession. So first is that stocks are not wild tickers for us to speculate. Uh, I come from a finance background. I'm a CFA charter holder. I really understand how FNO works and the whole hedging thing works. I've never speculated or traded in my life. I've never done an FNO trade. It's not even activated in my account. So for us, you know, entire attention goes to the business that is behind that ticker. And when we buy a stock, it is nothing but a fractional ownership of that business, uh, on that of that underlying business. For example, if you're buying Maruti shares, we want to be shareholders in Maruti for a long, long time because we believe in the business. We believe in its growth. This is just an example. We don't own Maruti. But the idea is that I can't create Maruti from scratch as a promoter. So as an investor, I still get an opportunity to participate in Maruti's growth from here on. That is how we approach investing. A typical average investment horizon is 3 to 5 years. It's much longer many times. Sometimes it's lower too. On an average, it's between 3 to 5 years so far. We prefer owner operators, so promoters who run their own business as CEO, MD. With skin in the game means they have high promoter shareholding and robust balance sheets. We don't prefer high debt, high working capital. Uh, that makes a business very fragile. The biggest reason for corporate bankruptcy globally is leverage, debt. If you don't owe money to others, they can't force you out of business, right? It gives you a lot of staying power. So that's our focus area. We are diversified across sectors and market cap. We have a single scheme, very sector and market cap agnostic kind of a mandate we have. Typically, we have 18 to 20 stocks in our portfolio. Anything above 20, we feel, you are diversifying beyond what's required and it's not minimizing return risk while compromising the returns. So from a risk management standpoint, a portfolio of about 18 to 20 stocks does that job for us. It's the sweet spot. We typically allocate between 3 to 10% on each idea, depending on where we see the risk reward. Uh, the last point, we don't believe in speculation, taking cash calls based on where market is. We are optimistic on India. We want to stay positioned for luck. We invest as long as we are finding investable opportunities, and then we stop. We don't say that Nifty 24,000 pe hai, bahut heated hai markets, let's sell and raise cash. We'll invest today if we are finding opportunities. If markets fall and still we don't find opportunities, we'll still sit on cash. So sitting on cash is a function of whether we can find opportunities or not, rather than Nifty kaha hai, Sensex kaha hai, and what's happening to overall markets. That's not something we do. So now we'll start the topic for which we are all here, and I hope I do some justice over the next 50 minutes or so. So if you think about it very fundamentally, whatever we do, we could be a banker, a lawyer, we could be in IT sector, whatever we do, just step back from that and think like a layman what really a business is. It is nothing but trying to add value to your customers. And it can be done in multiple ways. For example, on this slide, if you sell that corn after plucking it from the farm for 5 rupees, you're still adding value. You're making it available at my place. Right now, I'm sitting in Pune. If I get this at my place, I'm willing to pay 5 rupees for this. The seller might have bought it for $3, $4. So he gets 1 or 2 rupees from it. I buy it for 5 rupees happily because I don't have to go to a rural area in a farmland to buy it. The same product, when it's cooked and ready to eat for me like this, I'm willing to pay 20 rupees for it. And the next iteration of that is if you pop it and sell it to me in a PVR while I'm watching a movie, I'm willing to pay even 400 rupees for this. We all pay. Even when we're not willing, we pay, right? That's the whole point. Uh, Now, when this is sold for 5 rupees, the person makes 1 rupee. When it's sold for 20, he or she makes, let's say, 5 rupees. And when it's sold for 200, this person makes 100 or 150 rupees. That gross margin, selling price minus your cost of goods sold, is nothing but a reflection of what value a business is adding, right? This is the most fundamental we can go into. Everything else comes after this. This is your gross margin, sales minus raw material cost, all your overheads, salaries, operating costs, electricity bills, all of that then gets deducted from that, and you reach a profit margin. But if this structure is not in place, or if the value addition is very low, that means you're a very fragile business. For example, in first case, if somebody else is selling me for $4, I'll switch. But the probability will be lesser in second case because I like it cooked a particular way. And in the third way, while I'm in PVR, I don't have any other option to buy it from anywhere else, right? So you see, there is huge difference in these three businesses. Now, before we start analyzing the business itself, it's very important to know that does the business operate in a space which is exciting? And while the industry analysis itself is a huge concept, and we've discussed this for almost a day at Flame, uh, but for this class, for this session, I've just taken out 4 important points which are very simple for all of us to follow. And then if we say, okay, the industry meets all the 4 criteria, then we'll get into company analysis. What is the first one? The first one is, you've heard this term called TAM in startup pitches, right? Total addressable market. How big is the industry size? Why does it matter? Because if the industry size is not big, how would the company get big? Uh, you can be a big fish in a small pond, or a small fish in a big pond. Uh, but if you want to grow as a fish, you want to be in a large pond. You don't want that constraint to kick in. Uh, let's consider some interesting examples. I hope you'll be able to relate to it. So first is sugar-free. We all know this because we are the diabetic capital of the world, unfortunately. Uh, and this was the first large-scale brand that came up with the sugar substitute, and it's owned by a company called Zydus. They do 150 crores in annual sales. I know some of you could be surprised कि बस sugar-free का 150 crore sale है India में, but that's where the number stands. More importantly, this company claims that we have 95% market share. Practically, they are a monopoly. Stevia and other things which are there, practically put together, they are just 10 crores. Because the implied market size is 160 crores. If you say I'm 150 crores and I'm 95% of the market, that means others are just 10 crores. The next question is, so obviously you can't grow by gaining market share if you are sugar free because you are the market. So there is no question of growing big by winning market share from others. No. Then how can you grow? Only if the industry itself grows. Is it growing? The answer is no. Last 5 years, 10 years, it has not even grown at high single digit. Forget double digit. And we are in a country where nominal GDP itself is growing at 10, 11%, real plus inflation. And this doesn't uh, qualify to be called a high growth industry. Then what is the upside possible in this brand, in this company? Consider Honda generators. We all used to have it, right? This is the power backup when the power cuts used to be a lot. Now, at least in cities and urban areas, it's no more the case. But wherever it's critical, hospitals or other commercial operations where you can't uh, afford not to have regular power, this is still used. So they sell annually in India for 600 crores. They claim that we have 80% market share. Divide 600 by 80%, implied market size is 750 crores. Can't grow by gaining market share. You're already practically the market. Is the industry growing in double digit? No. Power is only getting better. Power backup demand, hence, is not growing. What is the maximum upside potential if you are betting on this company for this product? Unless these companies launch newer products, go outside, good. But for this product, what is the upside potential for these companies? Contrast these with these. Tanishq, which is owned by Titan, a Tata Group company, they sell annually for 45,000 crores. Jewelry made of gold, diamond, platinum for 45,000 crores. What is the market share? Single digit. What is the implied market size? 5.5 lakh crore. Can Tanishq continue to grow by gaining market share from mom and pop stores where people are not even confident if they're getting what they are told? 22 carat के पैसे लेके 20 carat तो नहीं दे रहे. We don't know. Is there potential for Tanishq to keep gaining market share? The answer is yes. Is the industry itself growing at high single to low double digits? Again, the answer is yes. Can this 45,000 crore, no matter how big this sounds optically, uh, it seems, can it multiply from here over next 5, 10, 15, 20 years? The answer is a resounding yes. होगा नहीं होगा किसी को नहीं पता. Possibility है. That is what we are discussing right now. And it's a 100% yes. There's no ambiguity in it, at least from an opportunity standpoint. HDFC Bank, 25 lakh crore का loan book है. HDFC Bank has a loan book of 25 lakh crore today. It used to be 16 lakh crore after the merger with HDFC Limited Home Finance Company, Housing Finance Company. It is now today almost 25 lakh crore. What is the market share? 14, 15%. Do we have, so what is the implied market size? 165 lakh crore. Is the market growing in double digits? Absolutely yes. Nominal GDP growth ही 10-11% है हमारी country में. GDP growth. तो credit cost तो grow होएगा ही ना double digit पे if the economy is growing at that rate. Households are borrowing more to buy homes, to buy cars. Corporates are borrowing more. Credit has to continue growing. Can HDFC multiply the loan book from 25 lakh crore over the next 5-10 years despite being very large? The answer is yes. आप सोचो 150 करोड़ के शुगर फ्री सेल पे मेरे को कॉन्फिडेंस नहीं आ रहा वो मल्टीप्लाई होगा नहीं होगा. 25 लाख करोड़ के लोन बुक पे कॉन्फिडेंस आ रहा है बिकॉज अपॉर्चुनिटी साइज कितना बड़ा है. The next is within industry analysis, we'll discuss four things I said. We've discussed one. The second is the concept of headwinds and tailwinds. I borrowed this from aviation. Tailwinds are nothing but when plane is moving, an aircraft is moving from point A to point B, and the wind is also flowing from point A to point B. It gives you a push from behind, takes you in the direction you want to go. You burn less fuel, you reach early. This is a setup given which is very favorable for the pilot, right? Headwinds are exact opposite. You're going from A to B, wind is moving from B to A. It's just taking you longer to reach. You're burning more fuel, can't do anything about it. That's the external environment you have been given to operate in. Let's try to apply that in the business world. Uh, so if you are in an industry which is growing at 15% CAGR, even if we are a very average company, we are not trying to win market share from our competition by being smarter than them. As long as we don't lose our market share, we satisfy our customers. By default, we'll grow at 15%. What if the industry is shrinking? The sales of the industry put together is going down. There'll be a cutthroat competition. We'll cut prices, we'll fight with each other, we'll give better deals to our clients. Ultimately, it's a race to the bottom. It's a absolutely loss-making deal for everybody who's part of that industry. I have some interesting examples to put the perspective more clear. So let's talk about health insurance in our industry, in our country. What is the penetration today? It is merely 4%. Uh, how are health insurance companies growing? There are three levers largely. पहला, you would have noticed हर साल जो वो renewal का premium आता है वो बढ़ के आता है, right? तो एक तो वो हर साल 5-10% पे हमारा premium बढ़ा देते हैं. दूसरा, we realize यार hospitals बड़े expensive हो रहे हैं. The medical inflation in our country is only going up every year. For the smallest of procedures, we pay a crazy sum to hospitals now. So every year we realize यार थोड़ा सा अभी 10 लाख था तो 12 कर लेते हैं, 12 है तो 15 कर लेते हैं, 15 है तो 20 कर लेते हैं. So we keep increasing our sum assured, and then obviously premium also goes up further. Third is volume growth. More and more people are taking health insurance. So there are three large levers of growth for the health insurance industry. How is that translated into numbers? The entire industry put together has grown at 20% CAGR over the last 10 years. I'm talking about the industry here, by the way. There are companies which have grown at 40% CAGR, 30% CAGR. And they are expected to grow at 15% for the next decade, the whole industry put together. Now, even if you bet on an average company here, 15-20% growth industry level pe ho raha hai. You bet on a smart guy, of course, he'll do wonders. But even an average guy will do okay. But contrast that, if you invest in companies which are in DTH, newspaper, radio, they're all fighting for our attention. And today our attention is very precious. It's divided. We all have this smartphone. It has an internet. We are hooked on to Netflix, Prime, Twitter, you name it, TikTok, Instagram. So when was the last time we saw cable TV, heard to a radio station, or ordered a printed newspaper? These are all dying industries. Slowly, some of them will revive to digital and other things, but the base business is going to evaporate over this decade or so. So even if you're betting on the smartest guy here, odds are stacked against them. It's not a conducive environment to do very well. The third point to consider is industry very regulated, and uh, just to show you how regulations can kill business overnight. Uh, China's edtech industry was valued at $100 billion just about a year or ago, and you had the smartest of folks invested in them. Alibaba, Tencent, Byte, all of them were large investors in these companies. One announcement by a Chinese regulator, one announcement, just killed it. These stocks went down by 90-95% overnight. Some of them were listed in NYSE also. NASDAQ, they just collapsed overnight. What are the sectors which are highly regulated in India? I've listed some of them here. There are many more. And we have seen examples, right? This is a recent example. We all use this service. Some of the people could be shareholders as well, and they would have had this root shock that, okay, ऐसा भी हो सकता है. Look, you can lose your license. Very normal. In all regulated businesses, it can happen, right? Uh, it may not happen for a while and then it suddenly happen. It can happen in a series to many companies. Look at pharma between 2015 to 20, what US FDA did to pharma companies was very painful for the companies, for the shareholders. But see, they have to do what is good for the consumers. You can't sell bad quality medicines to a patient who's already suffering. Or in case of a bank, you can't expose your customers' deposits or the economy to risk. So there are very genuine, sensitive, important factors why regulators behave the way they do. Just because we are shareholders and our interest is in that direction, we cannot ignore it. So it's very important to be cognizant of all the regulations that apply to the industries we are analyzing. The last is the industry, is it more of the capital goods nature or consumables? So capital goods are products which have very long life, they're acquired occasionally, whereas consumables are consumed frequently. Simple examples, all of us understand it. We buy a car once in a while, we probably use it for 5 years, 10 years, but we refuel it every now and then. We buy razors occasionally, but change blades very frequently, and so on and so forth, right? Uh, uh, there's this interesting analogy I use at my flame course. So, uh, looking for a life partner, most people would do it once in their lives. Some people would do uh, maybe twice, but most people do it once in their lifetime. So, if a company like Bharat Matrimony uh, gets a customer and then that customer gets married, he'll most probably would not be a customer again. So this company has to keep looking for new customers every year. There is no lifetime value of a customer concept here. Lifetime of the concept, lifetime value is just that 1 3 month 6 month subscription, if at all he paid. And I'm using he because mostly he pays. Uh, and contrast that with a service like this, a dating app. People keep coming back. People who are in that phase of life, they use to find friends, life partner, whatever. They keep coming back, keep paying, and this is all reflected in numbers. So Bharat Matrimony is the market leader in this industry, some 60% market share. Turnover कितना है साल का? 450 crore. It's nothing. It's $50 million, right? Tinder does, it's owned by a listed company called Match Group globally. $3.2 billion, 26,500 crore revenue annually, right? Essentially, it's a capital good versus consumable analogy I'm trying to make here. I hope you got it. So let's say that we found an industry where broadly these four things are in favor. It's a large market, it's enjoying tailwinds, it's not too regulated. So tomorrow all of a sudden something wrong cannot happen because regulator decided that, and there is a repeat purchase. You find a customer and there is a lifetime value associated with him or her. Once we do that, and then we are trying to find leaders in that space, or companies which are already leaders or will be leaders, and we want to invest in them and create wealth along the way. What is the problem here? The only problem here is that when businesses are successful in a free market like India, see, we are no more in the pre 1991 era where you needed to have a license to run it. It's no more the case. If a business is successful, everybody, everybody, not just from the industry but from elsewhere, attack that business and become a competitor in order to make similar kind of money. And they'll fight for your customers, for your vendors, for your employees, for your ad slots, for your dealers. You are going to face a lot of competition when you become successful, especially in a country like India. You're very, very competitive. Every company wants to be in every segment. There is no, that kind of focus ki theek hai, hum khush hai, satisfied hai, ek mein hum leader. Everybody wants to be everywhere. So tomorrow, if Ambani or Adani writes 1 lakh crore or 2 lakh crore check to become your competitor, how do you ensure your company is protected? And in this pic, what is uh, illustrated is actually a castle. Uh, it's your kingdom, and you want to protect that. And there is a water body around it. So you want to protect it through this economic moat. You'll put crocodiles in it, you'll put all sorts of dangerous creatures so that competition is not able to penetrate your area. What are those competitive advantages is the topic for rest of the day. So let me briefly pause here and ask you, do you spot your brand here? I'm sure most of you do. I love interacting and doing this in a classroom. I'm not used to doing this in a webinar, and I can't obviously see what you're saying even by raising your hands. But I'm assuming that you would have spotted, most of you would have spotted your brand. Let's assume I take out the packaging and now ask you to just see it. In fact, many of you would be able to, even just by the color of it, will be able to identify it. Let's go one step deeper. Let me allow you to just smell it. Some of you will be able to identify it. Let me allow you to taste it. Again, you will be able to identify it. So there are so many association at so many levels for you with your product, right? Uh, Can we do the same exercise for, let's say, sugar? I put most of the large brands here. This is a pic from Big Bazaar. I put most of the large sugar brands here. Let's say I take out the packaging and put it in a bowl on your dining table. Will you be able to tell me which one is which? They all look the same, they taste the same, they cost the same, which is why they cost the same. That was not the case here. They all cost different. You don't even notice their price. If they increase the price by 5-10 bucks, you don't care. You're not going to switch. You're not going to say कि sorbitol 70% solution या calcium carbonate का price तो नहीं बढ़ा था जो मेरे raw material है इसके toothpaste के. How can you increase the price? But here you'll actually compare because they all sell mostly at the same price and they all match each other because they know that you don't have a preference for it. So they are price makers, differentiated products, they are price takers. They're all commoditized, me too, same products. I have this interesting example here, and some of you might relate to it. So assume a guy walks into a store and asks for a thumbs up. And usually, retailers do this. They have this idea of pushing you something else by making this excuse. Let's say he says, thumbs up is not cold. Can I instead give you a Pepsi or a Coke? Usually what happens, for most brands, people compromise. But generally, those asking for thumbs up have a different level of cult, a different level of loyalty. So this guy could walk out of the store because he didn't find what he wanted and he wouldn't settle for anything else. So the retailer lost a customer who was not only buying thumbs up, but probably would have bought something else along with it. And hence, next time, retailer would have to ensure that I don't say no to a guy asking for thumbs up. This is called franchise value. And this is created by brands because that ensures familiarity and trust. It becomes your default preference. It takes decades, centuries to do that. Uh, we have seen our parents, our grandparents, our great grandparents consume and uh, prefer certain brands at our homes. And by default, while growing up, it becomes a part of our system. We don't think uh, while choosing that product. We know that's the default preference. So it hasn't happened overnight. UPS has been in existence for 2.5 centuries. Colgate, more than 2 centuries. Cadbury, Jockey, Page Industries in India. Nestle, Coca-Cola, Bata. It's a Czech Republic company. A lot of us think it's an Indian company. It's not. Kellogg's. Back in India, Dabur is like 140 years old. Britannia is 130 years old. Amrutanjal, Godrej. So the brand value these guys have created is a result of being around for over a century. It cannot happen overnight by a new competitor. And as most things put by Mr. Warren Buffett, this is also done beautifully. He says, no matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by making 9 women pregnant, right? Creating brand value is absolutely similar. It just cannot happen overnight. It takes decades, if not centuries. And you become an exceptional brand when you become synonymous with the category. So we don't call instant noodles, it's Maggie. Even you observe people, small kids going to a shop and even asking for other stuff like a YY or a top ramen, but they'll say wo wala Maggie de do. Nobody calls it instant noodles amongst the larger audience, layman. uh, we don't call it adhesive, we don't call it antiseptic liquid. You'll ask for it, somebody will give you Savlon. Most people settle. They don't say कि Dettol matlab Dettol ही था. You were essentially asking for an antiseptic liquid. And you have these examples, right? There are many more. These are exceptional brands. They become synonymous to the name of their category, which they represent, uh, because they created the category or they became the first mass brand in that. For whatever reason, they enjoy that privilege now. And then all brands essentially when they got created, they were increasing the engagement of consumers in that category. For example, Asian paints, until 60s, 70s, painters जाके लेके आते थे paint. वही 10 पेंट रहते थे, 10 कलर ऑप्शंस. Asian paints branded it. हर घर कुछ कहता है. It involved us emotionally in the process. कि आपके घर की आइडेंटिटी आपको रिप्रेजेंट करती है. And then obviously the tinting machine just changed the nature of this game. You could offer thousands of shades. Factory came to the retailers. Just you needed those three basic colors, mix and match, make anything. Inventory management became very easy. And obviously, they spent a lot of money on branding, and rest is history. Astral did that when they innovated this category. From iron pipes, we moved to UPVC, CPVC pipes. लीकेज का प्रॉब्लम खत्म, रस्टिंग का प्रॉब्लम खत्म, seepage का life became very long of these products. And plumbing is the biggest pain point in any real estate. They just solved it with obviously Salman Khan, but also they made all the plumbers their brand ambassadors. वो शर्ट पहन के आते थे उसकी टी शर्ट घर पे कि ये लो बहुत अच्छा है. Kajaria has been doing that in tiles. Mr. Bachchan has done that for APL Apollo. Low involvement category, mostly a construction product. And we were lucky to participate in this because this happened last decade. This stock has been up some 20 times. So we have been invested in this for a long time, and we saw this, we experienced this, how in a low engagement category with innovative products, branding, engaging with the channel the correct way, how a brand can be created. One message here is that the brands which have already created, they trade at very high valuation. So they're at best compounders. Big money is made when we identify something like APL Apollo while it is happening, or an Amrutanjan, which is 120-year-old business, but the fifth generation from a sleepy management, an aggressive management came slightly more aggressive. So what are the signs? How do you identify a turn in the brand building exercise of a company? First is improved visibility. So suddenly companies start spending more on ad and sales promotion. They appoint a new celebrity ambassador. You see the gross margins going up, which means that you're able to charge a premium and your working capital shrinks. So the trade turns. You're able to collect money faster, manage with lower inventory, and are able to pay your vendors a lot later. In all, able to pull out money from working capital. All of this increases your return on capital employed by reducing the investment in the business. So the idea here is neither to be too early nor too late, because the failure rate is very high in India amongst brands. So, I remember being at the Nestle analyst meet some years ago, some 5-6 years ago, and I remember Mr. Suresh Narayanan, the CMD, who made this comment. He said, Indian consumer is ruthless. He's even pickier, he or she is even pickier than an American. In the prior 3 years, 17,000 brands were launched in India, and less than 0.5% survived in that year. So imagine the failure rate. What are the odds for a new brand to survive 3 years out? It's negligible. So you don't want to behave like a VC because they have 100 investments and even one big one will be enough for them. We'll have very few investments. So we can't take that spray and pray kind of a philosophy. So the first big competitive advantage for a business is franchise value, and it gives loyalty as the benefit. Even a competitor, if he's selling at a very low price, like Coke or Pepsi will give me discount, but I am a loyal Thumbs Up customer. I don't mind paying a premium for Thumbs Up. That was the key message here. Second is distribution. So if you do a lot of branding, but your product is not available across the country, then it doesn't serve any purpose. It not only involves a lot of money, but a lot of time also. It's the backbone of the branding exercise. E-commerce की वजह से थोड़ा easy हो गया है कि Amazon पे अगर आप list हो गए तो ठीक है, Amazon is going to take care of the distribution, but it comes at a very hefty price. You have to pay 20-30% to just get listed. और फिर आप Prime में जा रहे हो and all those things come at a further premium. Any guesses how many stores ITC is available at? How many reach? What kind of reach ITC has in India? ITC, of course, has cigarettes. Then they are big into FMCG. Then they have paper. So any guesses? 1 lakh, 10 lakh, 50 lakh, 1 crore. Just think about it. The answer is 1 crore stores. It's a mammoth number. It's the most widely distributed company in the country. For every 140 Indians, we are 140 crores, right? For every 140 Indian, ITC has one store. That's the kind of distribution this company has created over the years. And reaching urban areas today is easy because you can get into a D-Mart or ठीक है, पूरा Maharashtra आ गया, most of the Karnataka आ गया. बिग बाजार में चले जाओ, स्टार बाजार में चले जाओ, overnight you get your product available in all the stores. What about this? What about Bharat? Very tricky. They don't have space to keep. They would not pay you cash. They'll say, ठीक है रख जाओ, बिकेगा तो दे देंगे. And you will get your product in a very bad shape. Loss of money, loss of stock. It's very difficult to build for rural centric products. It's very difficult to build this distribution today. So, I have this beautiful analogy of calling brand as a train. So, and distribution as the track. So, for the train to go anywhere, you need a track. And once you have a track, you can send any number of trains, right? So, track is that infrastructure on which you can run multiple trains. So, think of it this way. Haldiram is again one of the most well distributed brands in the country. They keep launching new products probably on a weekly or fortnightly basis. उनका ट्रक तो जा ही रहा है फैक्ट्री से, एक और कार्टन उसमें रख दिया न्यू प्रोडक्ट का at zero incremental cost. But for a new brand, to create that from scratch, to have that logistics cost, to appoint distributors, to subsidize them in the initial years, it is a mammoth task. Takes a lot of money, a lot of time, and very, very difficult to persist at it. Then there are legal barriers to entry. Things like patents. So think of pharma companies. You innovate a new drug, you solve a problem, you solve a disease. Government will incentivize कि ठीक है आपने इतनी चीजों पे R&D पे पैसा खर्च किया था, 100 में से एक सक्सेसफुल हुआ है, इस पे पैसा कमाओ. इस पे आपको 15 साल के लिए हम पेटेंट दे रहे हैं. रिवर्स इंजीनियर करके कोई और भी जान सकता है इसमें क्या है. Anybody else can figure out what is the formula, what is the composition. But we legally bar them from copying it. You make 99% gross margin on it. We don't care. Because you have innovated and done good for the humanity, 10-15 साल के लिए मजे करो. Once it becomes generic after 15 years, the price drops by 90%. And even the generic guy is making 50, 60, 70% gross margin on that. That shows you the extent of gross margin the innovator was making. Then there are copyrights. Think about a company like Saregama. 1.5 lakh songs ka music library hai. Perpetual ownership. Any song gets played anytime, anywhere, radio pe, TikTok pe, Facebook pe, anywhere it gets played, they get a royalty out of it. Beautiful business, nobody can copy it, perpetual right to those songs. Then there are regulatory licenses. In sin industries, you can't, no matter how much money you have, how much nice cigarette you can make, you without license you can't operate a tobacco, liquor, or a casino kind of a business. You can't enter defense, aerospace. You need environmental clearances for hazardous chemicals and so on and so forth. These are entry barriers for income for new players, which is an advantage for the incumbents. Any guesses how many resumes, how many employees are there on Naukri.com? 1 crore, 5 crore, 10 crore, 15 crore. The number is almost 9 crore. 9 crore resumes are there on Naukri.com. Now imagine if you were an employer and Naukri has 9 crore and the next employment portal has 1 crore resumes. And you have to put resume at one place, let's assume. Where will you put it? Sorry, you have to put a job opening. You are an employer. You have to put a job opening at one place. You obviously choose Naukri.com because more people are there who are looking for the job. And all other employers will also think like this. So all the new job postings will be at Naukri.com. Since all the jobs are at Naukri, the new resumes will also come to Naukri. And it becomes a virtuous cycle. Naukri.com is owned by a listed company called InfoEdge. It's a beautiful business, and this is nothing but network effect at play. And if you think about it, all these businesses, all classifieds, exchange businesses, Google services, social media, e-commerce, rideshare, they are winner takes all market. If you see the market share of NSE, 95%, IEX, 97%, Amazon, Google search, Google Maps, they are all winner takes all market. There is no place for the second guy to occupy market share and make money. They have competitors, but they are nowhere near the leader. These are all winner takes all market. It has only place for one guy to dominate and make all the money in that industry. Any guesses how many pairs of footwear Relaxo makes? Relaxo is the largest footwear company in India, and again, a company where we were lucky to ride this decade. It moved from some 500 crores market cap to a couple of $1 billion. And I used to be regular at the AGMs. We saw the whole transition from bathroom Hawaii chappal to sandals and shoes, whatever they did, premiumization. So coming back to the question, any guesses how many pairs Relaxo has in terms of manufacturing capacity per day? So the answer is 10 lakh pairs a day. Annually, 36.5 crore pairs. It is like for every fourth Indian, every year, Relaxo makes a pair. From this 36.5 crore capacity, last year they sold 25 crore pairs. And they invest about 100 crores per annum on advertisements. They have these different brands endorsed by different celebrities. So अभी आप सोचो 25 करोड़ पेयर बेचता है साल का 100 करोड़ एडवर्टीजमेंट पे खर्च करता है. It sells 25 crore pairs per annum and spends 100 crores on advertisement per annum. What is per pair cost of advertisement for Relaxo? 100 crores divided by 25 crores, 4 rupees. 4 rupees Relaxo spends per pair of footwear. It sells in a year. Now imagine if I am a new competitor to Relaxo, I get this big funding. कोई बड़ा PE आ गया, SoftBank आ गया. I got good funding, and I also invest 100 crores on advertisement in first year of my existence. Relaxo 100 crore खर्च करता है, मैं भी 100 crore करूँ. And let's say I'm able to sell 1 crore pairs. I sell 1 crore pairs in my first year, and I've spent 100 crores like Relaxo. My per pair advertisement cost is 100 rupees. I can never make money because for Relaxo it is 4 rupees. And what is at play here? It is economies of scale. I am distributing a very large fixed cost over multiple units, much bigger volume, giving me operating leverage benefit versus a competitor who's doing it at a very small scale in the beginning. And to reach at 25 crores, you would have to burn a lot of money. It's going to be a very painful journey for any competitor to live through. Then lowest cost producer in any commodity industry is the biggest and the most durable competitive advantage one can have. We know commodities are like sugar, as we discussed previously. So everybody is selling at the same price. It's a price taker market. आपका स्टील मेरे स्टील से बेटर है ऐसा नहीं हो सकता. Specifications अगर same है, it'll cost same. For the same specifications, it has to be priced at the same level globally. It's a pure commodity. So same like sugar. So what is the way for me to make more margins if the selling price for everybody is same? Just one way, reduce my cost to the lowest possible. How will it help me? In a good cycle, I'll make more margin than my competition. I'll have the best balance sheet because I'm making the most money. In bad cycles, when steel is being sold at a price lower than the cost of manufacturing, obviously there is a negative gross margin. Everybody in the industry is losing money. But if I'm the lowest cost producer, my negative gross margin is the lowest. And others are bleeding more. And a lot of them who would have, increased capacity by borrowing money, and now banks are after them. कि आप default कर रहे हो, IBC में चला जाएगा आपका. We'll take possession of your plant. At that time, the good guy with best balance sheet actually acquires the competition. This is what happened in last 7 years. So from Tata Steel to JSW, they acquired from Bhushan Steel to Reliance. सबका जो steel sector का 4 साल खराब गया, सब खराब players डूब गए और अच्छे players ने उनको acquire कर लिया. So I have this example of JSW and SAIL. This is 10-year average number, not 1-year aberration. JSW makes 48% gross margin. Steel Authority makes 56%. So Steel Authority का कुछ commodity advantage होगा, government company है. Let's assume they are in a 100-meter sprint, they are already standing at 20 meters. So एक starting advantage है JSW Steel से SAIL को. But once you reach the operating margin level, JSW makes 20%, SAIL makes only 10. So SAIL gives higher employee cost because government company hai. Technology mein JSW Steel is much better. Power cost, conversion cost, and all of that translates to a very high ROE versus SAIL, despite being much lower on gross margin. So JSW Steel is the lowest cost producer of steel in our country. I think we are running out of time. It's 6:05. I'm gonna just take 10 more minutes, and at 6:15 we are gonna try to wrap up and open for Q&A. So then there are something called switching cost. So switching costs are negative costs which a consumer incurs if he has to change supplier. For example, if I am, finding my petrol bill to be too high and I want to switch, even let's say this guy is switching his Mercedes uh, to a CNG, but you can't put CNG in your petrol tank. You have to first spend 75,000 rupees on getting this kit. So you have to then do the math यार कि मैं कितने किलोमीटर चलाता हूँ अच्छा पेट्रोल वर्सेस सीएनजी में इतना पैसा बचा लूंगा, but I'm also investing 75,000 on the kit. Now does the math make sense? What is the second problem you will have? This was the monetary question. What was the non-monetary problem you will face? यार मेरा आधा boot चला जाएगा. Those my airport trips and pickups and drops, half of my boot is gone. Where do I keep my luggage? That's a non-monetary switching cost. Same with printer. You could be having a cartridge wala printer, सूख जाता है cartridge, head खराब हो जाता है, original ink is so expensive. You want to switch to a tank-based printer. But what is the switching cost in this decision? As a consumer, what do you think? Printer ही change करना पड़ेगा. You can't use the same printer for filling the ink tank. You would have to change the whole equipment. What are the non-monetary, some more examples of non-monetary switching cost? We don't change our bank accounts. Dividend इसमें आता है, tax refund इसमें आता है, डीमैट अकाउंट में लिंक्ड है, सैलरी इसमें आता है, ईएमआई इससे कटता है. 100 reasons we don't want to switch our bank. ट्विटर पे जाके गाली देते रहेंगे सब बैंक्स को, इसका ऐप नहीं चल रहा, इसका ये नहीं चल रहा, इसने मेरा 100 रुपए 50 रुपए एक्स्ट्रा काट लिया. We keep abusing, and most of the people are very dissatisfied with the services of their banks. But how often do we switch bank accounts? There is a big non-monetary cost associated with that. Similarly, in large product companies, enterprise softwares, we in 60s we had mainframe, then we had, uh, you know, we had cloud, we had SaaS. So, but how many banks are able to make this switch? It's so difficult to do that switch. What if you lose data? You are tightly regulated. This is very sensitive data of the balances of and the trail of your investors and savers. So globally, one bank was trying to do this. It failed, and the CEO lost his job. So this is a very risky thing to do. While it is important to do, we have faced this while switching our operating systems from Android to iPhone or iPhone to Android. Then important to note here that switching costs can be taken away by regulators. Like bank accounts, we had a problem with our mobile numbers also. You were not happy with, let's say, a telecom operator, but you could not switch because everybody had that mobile number of yours. And then 6, 7 years ago, when Jio entered the industry, at the same time, there was also a change that came about that you can change, your mobile number will become portable. You can change service provider without losing your mobile number. It's being talked, it's now a part of health insurance also. Without losing your 3, 4 year pre-existing diseases ka waiting period, you can switch your health insurance. Try is talking about that for DTH also, but it's been forever, and there are hardware issues here. It may or may not happen, and by the time industry is anyways going obsolete. The last is access. So there are many more, but I had only 1 hour, so I could put only a few here. The last I'm going to cover in this session is access to natural resources. So, for crude oils, we know how Middle Eastern countries have hit a jackpot. In EV, cobalt is very important. There's a small country in Africa called Congo. Some 60-70% of the global known reserves are in Congo today. In India, Coal India has all the reserves. If you have seen Gangs of Wasepur, you'll know 60 में कैसे nationalize हुआ था coal. So India has the largest coal reserves in the world, and all Indian coal reserves are in this company, Coal India Limited. Then, based on soil and agrometric climate conditions, we give a geotag. For example, basmati rice के लिए मिला हुआ है हमें. पंजाब, हरियाणा और थोड़ा बहुत पाकिस्तान के एरिया में, if you grow basmati rice in that area, only then it can be called basmati rice. It's a geotag which has been given to us. So it's crucial to keep tracking because, economic modes are never static. They are always either improving or getting attacked. companies have to invest a lot of money to maintain them. You can't take them for granted. You know, when Facebook was at the peak, it did not stop there. It went on and bought Instagram. Instagram had some 20 employees. It paid, I think, some crazy 5-10 billion dollars, and then for WhatsApp it paid $20 billion. So it ensuring that I am not complacent where I am. I need to keep investing either organically or inorganically to ensure that the network effect remains at play for me. We all know Kodak camera, Nokia cell phone, Sony Walkman. These guys all were market leaders, innovators, technology leaders. They had a very big economic moat, but then something happened and it all went to zero. Uh, Two large profit pools globally, which are going through massive transformation, are auto and energy. Auto is moving towards EV. We may go to EV directly, or in India, probably we'll not leapfrog like US. We'll probably go to hybrid first, as it looks now. Let's see, but surely ICE, internal combustion engine, over next 5, 10, 15 years, uh, is most likely going to phase out. Similarly, in power, every household could be a power station. We're going to have renewable, we are going to have energy storage. Instead of sourcing from the grid, we could be selling to the grid. So these two are biggest profit pools globally. They are already seeing massive disruption. And often, when such disruption happens, incumbents get most impacted because they are the slowest to adapt, because you have to let go of what you have to do something new. It's generally, the Teslas of the world which will come and disrupt, and of course, some incumbents will evolve and stay in the game. A couple of slides, and then we'll open for Q&A. What are the best practices in investing? It's okay to find good companies, manage a portfolio, but if we don't have our foundation right, you know, at the at the broader level, things go bad. So I just thought I'll include these two slides before we end. First is knowing that putting money in FD and gold is good, but at best it is just matching inflation. It is not increasing our purchasing power. It is not beating inflation. It is leading to optical and nominal growth, but it is not beating inflation. So all if you're making is 6, 7, 8%, your money is the same. We should invest in equities and real estate to make more money, more returns, but only those which we don't need for at least next 5 years. Longer the better. If we are genuinely investing for our retirement, for our kids, that is best. We earn every month, save every month, we should invest every month. Try to avoid timing the market, entry, exit. It leads to so much taxation, brokerage, and leakages. We should never borrow to trade or do FNO. That's my suggestion. Without proper risk management, it can completely wipe out the entire capital in one day. If we have that urge to speculate in things like crypto, NFTs, we are somebody who want to stay ahead of the curve. We want to try new things. Ideally, we should avoid. But if we have that itch or urge, put that small amount which you're okay losing. It should be an experiment, not betting the house. Finally, if we make investing, if we make volatility our friend, we'll do very well. We get excited and go to malls when we get 50% off. We behave opposite when markets go down by 50%. We panic, we sell what we have instead of buying more. So if we fix this one small behavioral bias, I think we're going to do phenomenally well. You don't need anybody else. Common sense, staying for the long term, compounding is magical. T should be big. Focus R की बजाय T पे होना चाहिए. Instead of return, we should focus on the time horizon and ability to sit through the drawdowns. Rather put more money when markets go down. If you do this one thing, whether you invest through mutual funds, PMS, yourself, doesn't matter. As long as we just adhere to this one fundamental behavioral thing, I think we're going to do very well in markets. What not to do, Mr. Charlie Munger used to say, he was the most wisest person we had. Unfortunately, we lost him some time back. He used to say, invert, always invert. So there are hundreds of ways to be successful in markets. We don't know which one will work for us and in life, but very few short ways to go wrong. For example, in life, if we are very lazy, we do drugs, we are unreliable, unfair, we don't follow law, it's gonna lead to failure. But successful लोगों से बात करो तो सबकी अपनी journey थी. Then there are different ways to top of the mountain. Uh, Similarly, in markets, many ways to skin a cat, but some short ways to fail. What are those? leverage, FNO, speculation, intraday trading, listening to anybody on social media, and then putting our hard-earned money, our future of our kids, that kind of money, just on hearsay. So this is how investing looks like, especially for us in India. Forget the Japanese people; they were unfortunate for last 4 decades. But otherwise, if you see US, us, this is how investing looks like. Days are very volatile, years are okay, decades, given economy is in a good shape, continue to look like this. Some further reading, if you like this topic, you want to pursue, as a hobby or for yourself or as a career, I would recommend reading these 5 books. They are simple to read, and conceptually you'll understand a lot, behaviorally how these veterans have made money in markets. Uh, if you want to understand how we invest, we have a checklist which is freely downloadable from our dashboard, which is investor.stalwartvalue.com. There is a free guest account which one can create here and download the investment checklist. There are more than 100 points which we see in a company, for a long-term investing, and all of them are listed here. With points in business management, uh, valuation, accounting, shareholding, and so on and so forth. So all of that is covered there. With that, I come to the end of the session. I have my email address written here, my Twitter handle, my DM is open on Twitter. So if while we are opening the Q&A here, if there is anything later on also, feel free to reach out. Dinaji, I think with that, I think we can open the floor for Q&A.
Yes, thank you very much. If you look at the history of investing, there has been a movement from people-based investing. People looked at what Harshad Mehta or Ketan Parekh or whoever invested. Then we have a value-based investing, and that is where we stand today. So it is always good to go back to the basics. And when there is a high tide, what I have seen in the markets, like you have a high tide, lot of garbage flows on the seashores. If you see Nariman Point and the entire Marine Drive during rainy season, because of high tide, huge amount of plastic and garbage comes on the road. So same thing happens with investing also, that the kind of times that we are in, there is definitely a lot of garbage coming on the roads, and lot of companies who are not really worthy of their valuations, but 5% companies, promoters take advantage of sometimes. So at such times I think it is very important that we keep going back to our textbook way of investing, not looking at companies with very high leverage, not looking at not growing companies, and identifying those leaders which can really explode. We always look for, instead of having a very linear growth, a hockey stick growth. I think your talk has been very useful, because this is the time where the markets are at all time high, but at the same time, how do we identify those small diamonds and golden nuggets in this market? And I'm sure your presentation would be very, very useful. And everybody would think I am an MBA and I have studied all this. But I think it is always good to touch base at such times, especially when the euphoria is very high. And sticking to what Peter Drucker would say, that sticking to your netting and your carpet, I think that is very much which is important. So I will open the floor for questions. I think we have Rajesh Bhojani. Rajesh, you want to raise some questions?
Yeah, hi. Hi. I
Uh,
hope you can hear me.
yeah,
Yes,
yeah.
we can hear you.
So it was really a wonderful talk, and the moats part was particularly brilliant. I just wanted to ask, these days there was a time when nobody liked public sector stocks or public sector companies, and they were considered, not consistent and not good managements and so on. But now suddenly everything has changed. So now a lot of people consider PSUs as great investments, and that they will achieve great results and so on. What are your thoughts on public sector stocks, and whether do you think this change in perception is really something which is valid, or it's consistent with your philosophy?
Hi, Rajeshji. Thank you. So, to briefly share on this topic, you're right. For last 1.5 decades, uh, PSU was not considered investable for an entire generation of investors because of the bad experience they had. Uh, See, most of these PSUs are either in capital goods, like many defense names, or a lot of them are in commodities, oil, coal, banking. Banking is a commodity business. Ultimately, it's just the cost of funds play, right? Uh, so one is that in this cycle, both commodities and capital goods. So businesses have been doing better. That is one. The second is the behavior of the promoter. Who's the promoter of PSUs? It is the President of India, and it is the ruling government, which keeps changing. So we have had stable 10-year government, and for a change, the behavior has been better. Otherwise, often welfare agenda would come into picture. Margins पे बहुत restriction लग जाएगी, policy change होते रहेंगे. जैसे ही थोड़ा स्टॉक बढ़ेगा तो प्रमोटर मतलब गवर्नमेंट ऑफ इंडिया अपना स्टेक बेचने आ जाएंगे. तो काफी फंडामेंटल और टेक्निकल इश्यूज रहे हैं इन द पास्ट, which is why PSUs were not liked. Now those industries are doing well, and the promoter is behaving himself. So stocks have done well. Now, whether it is structural or cyclical, time will tell. But in my judgment, most of the issues in PSUs are fundamental, and they could resurface. For example, why did we have so much crash in these names on 4th of this month? Because there was some fear that government may not come back with majority, and then the coalition government, how would they behave? uh, Nobody will stay in power forever, and these things will keep changing. So ultimately it depends on the promoter and the industry cycle. Currently both are in favor, so it's doing well, but it's subject to change. So our mandate does not allow us to look at this in a big way and be overweight on these things. uh, we like to think of terminal values. Biggest value in any business comes from its terminal value. So for somebody who's playing short-term cycle, this has made a lot of sense. But our process involves really looking out in the future, and the basic parameters should meet, which are a lot of them are missing in this case.
Okay, we have Darshnil. Darshnil, you have a question. You have raised your hand. Darshnil? Sorry, it is Darshil. Darshil, sorry. Can you unmute him? Okay, meanwhile, Sarthak Mohanty, you have raised your hand. Sarthak Mohanty. Sarthak? Okay, they are not asking the question. So I think, to continue with your this.
Hello, hello. Am I
yeah,
audible?
please, please. Yes, yes, yes. Who's this?
Yeah. This is Sarthak, ma'am.
Yeah. Sarthak, yes, please go ahead.
Yeah. Hi, Jatin. Good evening, and thank you for that very informative session. I actually had two questions. So, my first question was, you had broken down the metric on to value a business. There are three parameters. One was the business itself, the industry. The second was the management and the jockey itself, and the third one was regarding the valuation.
Yes.
Right. Now, after that, you had told that you are looking at building a portfolio of 15 to 20 companies. In that context, I had a slight, I wanted your perspective on something. On regarding global companies, in the sense that, let's say a company or an industry is one where which is not available in India, let's say in Amazon many years back, or let's say the management of that global company in that same sector is better. Let's say Cognizant is better than an Infosys. I'm just hypothetically saying,
Sure.
or the valuation of that industry or the country itself is cheaper. In that sense, doesn't it make sense to include global uh, different industries or the same companies which may be similar to India in a global context?
Absolutely. If you are able to understand those companies, their accounting policies, track them, have confidence in them, and you have a structure where you are able to have, an account in US and able to buy them, track them, why not? In our case, our mandate is specific to India, so we don't do it. But in your case, if you are able to spot and find opportunities and you have a way to participate in it, why not?
Right, right. And a second question. This is regarding that the last slide you were speaking about commodities such as gold. They have given just inflation hugging or barely beating returns over the last 30, 40 years, which I completely agree with. But another thing is that there is a thing of asset allocation, which in many of the models, they suggest a 5 to 15% allocation to gold. I mean, assuming that's your thing to diversify. Now recently the Indian stock market, as you will be aware, has its Schiller Cape ratio is more than 2 standard deviations above its mean. It is, I mean, even the US market also. So in that context, the asset allocation would be for a person who is having, let's say, who's targeting a 10% gold allocation would now be less gold oriented because of the increase in the stock portfolio.
Correct.
So in that case, doesn't it make sense to, tactically to load up on gold or SGBs to get an advantage when equities are less
Sure.
likely to make a
I
good
think
return?
I think I got your question. And at a personal finance level, where we are talking about asset allocation, it completely makes sense. While gold is a non-productive asset, and at best it is an inflation hedge, I am not against it. All I'm saying is that one should be aware that in the long run, it is just matching inflation and not beating it. As long as that awareness is there, and we know that this is the role, this gold 10%, 5%, 15% doesn't matter. We should be aware that in our portfolio, this much gold is there and this is the role it is playing. After 10 years, we should not be disappointed thinking equities mein itna ban gaya, real estate mein itna ban gaya, gold mein to bana hi nahi. A lot of people even justify buying gold jewelry without realizing kitna making charge lag raha hai. Or even digital gold, you pay GST. Uh, so the only point is that we should be cognizant that this is the role gold plays in our portfolio. And if it's about safety, then it should ideally be physical gold. That is the ultimate
Yes,
last
correct.
resort. It should be yellow gold.
Yes, and because
Yeah.
yeah, because it's a hedge against the sovereign risk, sovereign default risk. I mean,
Absolutely.
sovereign
Before
credit
currency,
risk.
we had gold, and going forward, if for whatever
Yes.
reason if there is a collapse and currency loses its value completely, it is going to be gold again because that is universal. It's limited supply. Everybody agrees on it. It is the primary criteria of something to be qualified as store of value or for exchange.
Okay, I think,
Right, right.
guys,
Thank you.
let us close the discussion with this thing can go on and on. There will be a lot of questions, but I think you cannot learn swimming without really falling into the water. So I'm sure a lot of you must be investing, but revisit your portfolios, see if you know the basic principles of stock selections have been followed. Darshil, I'm sorry, you had a question, but Darshil, I'll have to stop here. This entire talk will be available on YouTube, so I request you that within next 2 to 3 days time, those of you who have missed 2 days this, or you feel that the talk was really very valuable, you want to refer it again or you want to refer it to your friends, please go on YouTube and you will find this talk on NMIMS Alumni portal, and it will be useful to all of us. And once again, Jatin, thank you very much for your detailed presentation. Of course, the rains have maybe flooded our people with other ideas. But I'm sure all of us who attended, we got a lot of value. And though I am, 4 decades into investing, everything I learned something new. So thank you very much. And with that, our next talk is going to be on artificial intelligence. More details will be made available in due course. Thank you very much. And thank you to the entire computer and IT team and the marketing team of NMIMS, who have been very helpful in helping us, have this show and managing the entire infrastructure. Thank you very much. Thanks a lot.
Thank you, everyone.
Thank you.